Hi, I'm Peter Rose, founder of Longwood Currency Trading. I wanted to do a short video on how I scalp because I've had some questions about folks. Am I a day trader, swing, position, scalp, Tuesday trade? What am I? What do I do? And so I thought I'd take this opportunity because I consider myself a day trader, but I've also done swings and positions and periodically do scalping. So I've talked about all those and how I transition among the different phases. But I don't really talk about scalping too much because that's a totally different thing altogether. Scalping is not done in any resemblance to normal trading, even day trading. So it's not for the faint of heart. So I thought I'd just chat with you a little bit and see if I can't convey some of the ways that I do it and see how you do it if you've tried it before. So it's a beautiful day out. I was just out to see if my friend had dropped off the last 2 cords of wood that I need for the winter, and he hasn't done that yet. We've been on and off with rain and all that kind of stuff, and so he can only drop it when he can get out into the field and load the truck up. So I got to wait for that. So this whole thing about scalping, what's the difference between scalping and day trading? In day trading, you're going to take 1 or 2 trades, maybe 3. But the key to the concept of day trading is you want to be flat at the end of the day. The difference between that and scalping is that you're going to do many trades and you will be flat at the end of the day. Not just 2 or 3. You're not looking for 10 pip runs or 20 pip runs. But you do need volatility in order to scalp. You're not going to scalp on a low volatility market because the idea is that you need to have movement. You're going to take very many positions, safely bagging X numbers of pips. And when the thing goes against you, you're going to get out. So you say, well, if it's going in your favor, why not continue to let it go? It's a psychological thing. How far will price go? It's tough enough to judge the volatility, right? The momentum. So how far will price go before it has a retraction? In our current market environment, trading on a 5-minute time frame with an ATR of about 5 pips, you're getting maybe 10 or 15 pips, and then you're going to get a retracement somewhere along in there. And that retracement can be 5 pips, 50 pips, 8 pips, 10 pips. You don't know what that's going to be. So your strategy in dealing with that has to involve things like win-to-loss ratio, per trade expectation values, average win value, and a whole host of stuff that you don't have to concern yourself with as a scalper. The only thing you need to concern yourself with as a scalper is get out right away when the trade moves against you. Because you're trading small, you don't trade with a lot of heat when you're scalping. You trade small, then getting out is not a really big thing. I was doing, probably I can do 1.2% a day against my risk, and I keep my risk the same. If I'm trading a full lot, it's $10,000, and that's what I scalp. I don't go 1 full lot, 2 full lots, 3. It's 1 full lot or 3 full lots or 5 full, whatever that is. It's constant throughout the day. So you bang away and you pick up pips and you lose just a few, and then you bang away and you pick up more and you lose a few, and the return is 1.5%. Whereas in a normal day trading, I think if you get 0.5% a day, remember 0.5% a day, 5 days a week, the 200 trading days a year is 100% return on your money. In that aspect, you're looking for that 0.5, 0.8% return on a daily basis in your day trading in order to accumulate enough money by the end of the year that you're going to be way ahead of the game in that 40-60% return against your risk. Those of you that don't believe that, what you're trying to do is compound, or you're trying to get more pips. And both of those are incorrect views in trading as far as I'm concerned. I'm not going to get into that today because that's not the focus of the video. At the end of the year, I've taken all the size trades that I've made and I aggregate them together and find out what the average size of the trade is, and I divide that into whatever my net profit is to calculate my yearly return against risk. Otherwise, you are compounding and changing the size of the trades and going for more pips and all this other stuff, trying to maximize your trade on a per transaction basis. And it becomes inordinately difficult when trading is really so simple. And scalping is an order of magnitude easier than day trading because you don't have to concern yourself with anything other than the ability to take a short loss. And understanding that if you take that short, well, you got to know how to trade first, and you can't learn how to trade by scalping. You learn how to trade being a day trader, so you're flat at the end of the day. You don't have to worry about carries going nutty on you. You learn how to trade that. In the midst of learning that, you learn, oh, geez, I've just picked up a trade that's could be a swing point, and then you go into your how you manage a swing position. Or the thing goes through in that swing position, all of a sudden looks like it's got the juice to keep going. Well, I'll hold that overnight. I'll do a carry, I'll throw a trailing stop on there, and everything is going to be great. Now you're in a long-term position trade. Or maybe you're doing 3 or 4 day swings, and you get caught in the thing hasn't ended yet, it's just still going, and so you're going to go and carry that. I consider in the currency markets, if you go over about 3 or 4 days, you're a long-term position trader, because your daily candle size is on the majors is anywhere from 80 to like 120 pips. I've seen them at 180 pips over a 14 period, but 80 to 120 pips or so is a reasonable range for your daily candles. So if you're going to hold that for 10 days, you could be getting 1,000 pips, right? So that's a long-term trade once you go over 3 or 4 days, because you have to manage the trade as to how much you're making for the number of pips that you're getting. It's a little bit different thought process when you're in the stock market, where a long-term trade might be months, and because you're paying long-term capital gains against trades that are only held for a year and a day. So the concept of long in the stock market becomes really long. Whereas in currency trading, because of the structure of the market, long and short term are condensed. They're different because the market itself is different. The reasons for the market is different. The order flow is different. Currencies are different. If you can trade stocks, you may not be able to learn how to trade currencies. If you learn commodities, the transition might be a little bit easier. Or maybe if you're doing index futures, that might be a little bit easier to transition into currencies. But for the most part, most people who are not trained in finance or have a lot of experience, and they're only investing knowledge is on real estate, even if you don't own any real estate, you understand basically the dynamics that you're not going to buy a house today and flip it out tomorrow and make any money just because of all the carrying costs and all the other shit and stuff that goes with it. So when you get down into the currency market, where the price action can flip on you even within 15 pips and turn around and go 50 pips in the opposite direction before it clusters and then turns around and continues on the direction that you want it to go on. And there are reasons for that, and if you don't understand the order flow, then you're certainly not going to be any good in trading as a scalper in the currency market. because it's all based on order flow and understanding that order flow. You really have to be aware of your risk when you're doing scalping. If you let one trade get away from you for 10 or 15 pips, which wouldn't be bad on even on a day trade, it'll decimate you on a scalp. But think about it. You're going to go 15 pips out on a full lot. You're 150 bucks out. Now you go back to your scalping where you're trying to clip 2, 3, 4 pips at a time. How many 3-pip moves are you going to have to make up a $150 loss? Well, you're going to have to make up a lot. But if you cut that trade short at 5 pips, how many trades are you going to have to trade in order to make that up? Or you're going to have to trade 2 of them, right? If you're doing 3 scalps, it'll take you two trades in order to make up for the 1. Your win-to-loss ratio has to be somewhere in the order of 80-20, 80% winners and 20% losers in order to be successful. The guys from Tasty Trade have a saying, trade small and trade often. And I think that's really the best advice for or I'm not giving you any advice. It was the best advice that I have ever heard as far as how to approach the scalping. Don't worry about anything else. There's no dependency on news. There's no dependency on ATRs. There's no dependency on entry analysis. There's no risk management other than get out quick. I mean, there's nothing that you have to do. You sit down, you look at the desk, you get an idea of where the price is going and what the magnitude of those little moves are on the 5-second chart, because that's where you're trading. You're living on the 5-second chart with the 1 minute chart on the side so that you can get an idea of short-term duration from some moving average lines, for example. You might be looking at that 8-period moving average line on the minute. So what's happened over the last 8 minutes or the last 13 minutes or something like that. And then you're looking at the 5-second chart for what's happening right now. Because every time you put that trade on, it's 50-50 jump ball as to whether the next tick's going to be up or whether it's going to be down. So you're really playing on a tick-by-tick basis. That next tick is 50%, 50-50, whether it's going to win or lose. The next tick is going to be 50-50, whether you're going to win or lose. The next tick is going to be 50-50, whether you're going to win or lose. But the order flow is going to determine that over the long run, you're going to have, if you can pick that general direction up out of the 1 minute chart, or you might go out to the 5 minutes to make sure that 1 minute is going to flip around on you. Well, I wouldn't go any higher than that. In order to say, okay, I'm going to make 6 or 8 trades in the next 10 minutes, and I'm going to be picking up 2 pips at a time. I'm just going to go in. I'm going to pick 2 pips. If it's still going, I'll go back in. I'll pick up another 2 pips. Oh, I'm going to lose 5. Okay, I go back in. I pick up 3. I go back in. I pick up 4. I go back in. I lose 5. I go back in. I pick up 5. I don't know what that sequence lines up at, but there's an awful lot of winners there in relationship to the losers. Because it's not like day trading where you're doing entry analysis and you are faced with that trade very likely going against you 5 to 8 pips before it, really fulfills the entry guidelines that you had. Oh, I think this thing has got enough juice over a long time frame to move 20 pips. That's how you structure a day trade, or you're looking for 20 or 30 pips of potential room to move, and you're hoping to scalp out of that 12 or 15. You're not going to get the whole 20 pip run. If you do, okay, stay with it, float your stop behind it, make sure you get your 12 or 15 pips out of it, and bring that stop up, even if it's 3 pips away from where the current price is, because you need to lock that in. You can't say, oh, I'm going to wait 8 pips for it to drop, because then you're not getting paid for the risk that you took and the benefit of the trade. And that all gets into stuff that I work on in my consulting work when I talk with somebody. But in scalping, you don't have any of those concerns at all. You just have to know that you better damn sure be a good trader, because the good trading means that some ratio you're going to be winning more that you're going to be losing. So you take the amount that you are willing to lose on a scalp, call it 5 pips. Let's say I lose 4 times in a row, 5 pips. I've lost 20 pips. So what do I have to make on the next 6 runs to make up for the 20 pips? Well, that'll give you 10 pips. So you got to make 5 pips 6 times to make up for the 20 that you just lost. Well, maybe what you're going to have to do is you're going to have to win 8 times to make that up. And maybe it won't be 5 pips. Maybe then you can get 3 pips. 8 times, that's 32. So now by constantly increasing the number of winning trades that you're capable of based on your trading ability to judge those trades, that gives you a clue as to how many times you can afford to lose in that day. And if you lose more than it's reasonable for you to make up in the day, you just got to figure, the car's not running good today. I got to go back and I got to tune that engine because it's just not working for me today. And so you just close it down and you go away. Generally, in a day trading environment, that's really not what you do. You make a nice big hit. You say, "Oh, geez, I just made, I just made $700 or $800. I've got $200 or $300 that I could risk losing, and I'll still make $500 a day, which is what the goal is that that I want to make." And so you go in and you take that other trade, but man, you got to click that short if it's if all you got is $300 to go. I mean, if you trade the 3 lot, it's 10 pips, and then you're out. You got to get out. So if you've only been trading a 3 lot to get to where you're up that money, and you can only afford to lose 3 pips, then you better just go in with 1 lot and trade that next one. And if that comes back 10 pips, oh, okay, well, you've lost $100, and just call it a day. So when you're day trading, there's a scalability of those following positions that you take in order to preserve some amount of gain for the day, so that you don't end up the day with nothing to show, or if what you show isn't significant of an amount of money to win in relationship to the amount of money that you've put at risk. Even 0.3% of a percent a day on your risk, it's going to mount up at 200 trading days a year. 200 times 0.3. What are you coming up with? You're coming up with a pretty good percentage gain on your bank. So I always consider that if I get 0.3%, I've made 0.3% on $1,000 is $3, so it's $30 a day on 1 lot. $30 a day times 5 is $150 a week. That's $600 a month. As you're working through it. So you're $7,200 up for the year, right? If you're trading a 10 lot, it's $72,000 a year. It's fine. But when you're actually trading, if you only get 0.3%, if that's where you're looking for, 0.5%, you don't get that made up when all of a sudden you take a 4% hit against your bank because you did something stupid. I took a 6% hit against my bank, midday during a couple of trades that I was blew out a couple of weeks ago, and turned that around to a 3% gain on my risk for the day. So I had a 9% swing on my money for the day. But it becomes difficult to do that when you're scalping, because your win to loss ratio has to be so high, because again, the mathematics of how you manage your trades as a day trader is radically different than what you need to manage as a scalper. And there's certain things that you have to do to plug into different equations to say, if I'm a such and such a day trader with a such and such win to loss capability, if I translate that same win to loss down into my scalping, and this is what I'm willing to lose, and I'm hoping to gain this, but I'm locking the loss in, then I got to figure out how many pips I have to make each time that I win in order to call that scalping process well done. If I limit my loss to 5% or five pips, and over the course of, and that's 20% of, or say two out of 10 trades, you know, I've lost $20 on a full lot. But now if I make an average of 4 pips on the rate 80, now I've got you know, $320. I've lost 20. I'm up $300. You have to go through those calculations before you can start scalping. So you're going to have to learn your day trading really well in order to develop some trading metrics. And if the trading metrics aren't very good, then you can't scalp, because you're not going to be able to change that to the metrics that you're going to be able to need in scalping. You're going to get wiped out. And that's why so many people poop on the scalping, because they don't know how to do it. They don't know how to approach it. And you really have to change the way that you think about it. You know, I've always said that if you can learn how to day trade successfully, you can map that up into being a successful swing trader, and you can map that up into being a long-term position trader, because the principles that you're doing as day trading will migrate up. They don't migrate down. You have to change those, but you have to understand what it is you got to change in order to make those changes. So you have to start out as a day trader. And God forbid, don't even think about, if you're a swing trader, you don't want to do day trading, you want to swing or be long position trading, don't even think about going into trying to day trade or scalp, because you're going to just end up in the trash can. Okay, don't do it. Scalping's a whole other different animal. Understand that. Understand that the conditions that will enable you to do scalping is that you're a good trader, at least as a day trader, that you're a good trader. And it doesn't count if you're a good scalper, a good swing trader or a good long position trader. Don't even consider scalping. But if you're a good day trader, then you know how to trade over consistency. And you better have 6 months or so before you've seen enough of the market in order to have the metrics to show that you are consistent, and what your win to loss ratio is. To have the confidence to be able to move that down and scale that the way that it needs to be scaled in order to be a successful scalper when you decide that you want to scalp. Do you want to scalp every day? I don't know. You know, if you're heading off to work and you don't see the conditions that are there for a day trade that you can get out of within an hour or a 2-hour period of time, and you've only got 45 minutes or an hour to scalp, and you know what you're how to trade, you could sit down and make 0.5% on your money, just boom, 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 like that, very quickly, and then go off and head off to the job or your appointment or whatever it is that you need to do. You should try that. If you're day trading like I am, you should go back and try the scalping sometime. Don't do it in a demo either, okay? If you want to check it out, let's say you're trading 3 fulls and you're doing that on a day trading basis, or 5 full lots, and you're working your way through and you're successful at that, you've got a grip on your emotions, take a mini lot and go back and just try the scalping and see what works. Because you're not going to be afraid of backing out, losing 5 pips. It's $5. You got $1,000 there. You lose $5. You lose that 5 times. It's $25. That's nothing. You can lose very, very many times to finally figure out how you have to readjust that scope to match what your results are in the day trading skills that you have. And then sometime when you're short time on your before you have to go to work, like I said, you don't have maybe that hour or 2 hour time frame in order to wait for some trade to go 12 or 15 pips. Well, wait for it to go 3 pips and get out. You made 0.3% on your money. Okay, 3 pips is 0.3%. You're done for the day. If you're trading a $10,000 account, 0.3%, like I said, is it's $30. You make $30. You're doing okay. $150 to 300, 600 bucks a month. You're making $600 a month. How do you go wrong on that? You can't. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.